Welcome to Real Vision here. I'm talking to Leo Kolivakis, who is the founder and editor, publisher of Pension Pulse. So, you're a pension expert, Leo, and I'm talking to you because, we're in the middle of a crisis that really, I think, is affecting pensions. And I want to get your perspective on, what the effect exactly is on pensions, their solvency, and what the risks are going forward. So thanks for joining us.
Thank you for having me, Ed. I'm glad to be here and glad to talk about pensions, the pandemic, and how it's affecting pension plans all over the world. The first thing I would say is the obvious that pensions are getting clobbered on two ends. One, the assets are getting hit. Stock markets are getting hit. Their public and private market assets are getting hit. When you have synchronized shutdowns of global economies. The other thing I would say is they're getting hit on the liability front as interest rates decline to record low levels. And that is particularly worrisome because the funded status of these pension plans really are deteriorating fast as interest rates decline so rapidly to levels we haven't seen in decades.
Right. And, you and I, we were talking before we got on camera a little bit about how to think about pensions, which ones are in trouble, which ones are not. And I think the takeaway that I had is a lot of it has to do with, one, governance before the crisis, and two, your funding status, which are intertwined to a certain degree. Maybe you can talk about that in the context of Canada, where you are, and the United States, where I am.
So the way to think about this is the same way you think about any company that came into this crisis with strong balance sheets, little leverage. They will be able to weather the storm a lot better. I mean, they're going to get hit, but they're going to be able to weather the storm a lot better than companies that came into this crisis with really bad balance sheets, high leverage, and that were struggling going into this crisis. So now let's take that into the context of Canadian and U.S. pension funds. Canadian pensions came into this crisis very well funded. I mean, they were fully funded or overfunded in some cases and had surpluses. And that was the cushion that provided them this is the cushion that provides them, allows them to withstand the crisis. However, they are going to get hit. Obviously, they're going to get hit. Everywhere's going to get hit. But they will be able to capitalize on the dislocation in markets across public and private markets and probably come out of this ahead 4 or 5 years down the road. Not probably, they will come out of this ahead 4 or 5 years down the road. U.S. pension funds, on the other hand, came into the crisis underfunded. 70% funded status was the average, but many of them were below 50%, which I call chronically underfunded status. So those chronically underfunded state pensions, not only are they going to get hit on the assets and liabilities side of things, they're going to get hit because they're not going to be able to capitalize on these dislocations of markets because they need the money to pay out pension benefits. And a lot of them I'm worried, are not going to be able to recover from this crisis, especially if the duration of the crisis is a lot longer than what we are currently anticipating. And that's what worries me. There's a lot of uncertainty that's still out there. I believe the duration of the crisis is very much underestimated, and that's going to affect all asset management firms, including pensions.
The most interesting thing in everything that you just said for me was the whole concept of being underfunded and not being able to take advantage of opportunities as they arise as we come out of this recession. I know that South Korea is a country that has come out of the first wave of the pandemic first. And I noticed on your site, you were talking about CPPIB, that's the Canadian Pension Plan Investment Board, and a counterpart in the Netherlands getting into South Korea in a logistics company. Tell me, is that the sort of thing you were talking about? Are those the kinds of opportunities that you were discussing?
Correct. So think about it this way. I mean, that deal, by the way, it was like an Encore joint venture. So they have already had a venture with this logistics company in Asia called ESR. So APG and CPPIB basically added more money to buy more logistics facilities in South Korea, and that's a long-term investment theme for them, which is the Asian consumer, the rise in e-commerce. That makes absolute sense. Um, the strong balance sheets of Canadian companies, I can't overstate this, is it allows them to take advantage of opportunities as they arise and take advantage of dislocations in the markets, whether it's public markets or private markets. The other thing that Canadian pension funds have, because they went into this crisis with very strong balance sheets, is they are able to leverage up their balance sheets. So they're even able to borrow more to take advantage of any dislocations of markets to see. And the reason why they do this is the cost of borrowing is cheap relative to the long-term returns they can make across public and private markets. Unfortunately, many U.S. pension funds are not able to do this. They're not able to leverage for a lot of reasons, but primary reason is their balance sheets are terrible.